Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss Federal Reserve interest rate policy, corporate earnings growth accelerated in 2025, stock indexes enter correction territory, and a look at the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are you, good sir?
Hanging in there. A few more weeks of tax season, and then things will lighten up quite a bit, I'm sure, and be able to catch up on some other things. But at least we're close enough we can see the light at the end of the tunnel.
Yes, sir. Well, and hopefully right about that time, the weather's starting to get pretty good for us here in Central and Northern California, so I need to book another lesson with you at the driving range.
That's right. It's not too early to start thinking about the Plan Solutions golf tournament in October, right? and start getting prepared.
Yeah, absolutely. I want to up my game, as does my son. So, all right. Well, let's dig right in. Federal Reserve interest rate policy, been a hot button topic, usually is a hot button topic, but what did the feds commit to in the open market committee as far as the moving or shifting of interest rates?
Yeah, in the recent meeting, the Fed held interest rates steady, which wasn't a big surprise. They had, been signaling that for some time. Last year they lowered interest rates kind of early on, brought them, a little, I guess actually more than last year, before last year. They lowered interest rates to bring them more into kind of a neutral territory, and then went on pause, right? And so they're kind of monitoring the situation and would make adjustments as needed. But now with the soaring oil prices, it's really causing the Fed to kind of rethink things. As a refresher, something we've talked about a lot of times, the Fed has a dual mandate. So their job is to balance full employment, which basically means a low unemployment rate, with price stability, which means low inflation. So when they're concerned about the job market, they may lower interest rates to try and boost economic growth and create jobs. When they're worried about inflation, they'll raise interest rates to slow economic growth and reduce consumer demand to try to ease those price pressures. And I think what we're seeing right now is the Fed's a little more concerned about the latter, right? The impact that rising oil prices may have on consumer prices, and so they kind of signaled that as they held interest rates steady, but looking down the road, saying they may be more cautious going forward.
Yeah, absolutely. And does as that shift of the potential consumer prices going up, is that concern maybe around in the economic potential, and I say potential, instability really around how this could play a role in unemployment? And the reason I ask is there, some case studies, some histrionics around when oil prices really rose, that maybe some unemployment growth started to happen, or past inflation, weakening of the economic growth, and so on?
Yeah, I mean, the truth is the Fed's in a tough spot because with the increase in oil prices and restriction of oil supply, there's that 1970s stagflation type scenario is maybe more likely, which is high inflation and weak economic growth. So really, both of the things that the Fed's supposed to manage, both of them becoming a problem. And with the Fed's tools, it's really a balancing act. They can really only address one or the other typically. So if both are becoming a problem, and yeah, if high oil prices, cause inflation to go up, right? Because that's being passed through to us in terms of price at the pump, or it's being factored into transportation costs of, a lot of the goods that we may consume, those types of things that could lead to higher inflation. But at the same time, if there's literally limited supplies of oil, that could lead to reduced economic growth because it's a major impact for input for a lot of businesses. And so, I mean, what does the Fed do in that situation? Do they tackle one problem over the other, whereas they could potentially make the other problem worse if they were to shift rates one direction or the other?
Yeah, we started out the year discussing a potential expectancy of the Fed's keeping interest rates either the same or potential slowly moving them down. But now this really paints a potential different picture as we move forward in 2026.
Yeah, yeah. Just a month ago, the market was pricing in that the Feds would hold interest rates steady for pretty much the first half of the year, and then, slowly lower rates in the second half of 2026. But now with the disruption to the oil market, the market's actually pricing in a 52% probability that the Fed will increase interest rates at least once here in 2026. So it's been a pretty significant shift, right? From expectations that rates are maybe on a glide path downward to now they may be inching up. And I think that's a big part of what we've seen priced into the financial markets is an expectation that the risk is now to the upside, which would be typically a negative for the financial markets versus the more positive outlook that the variability would be to the downside for interest rates, which would be rather supportive of financial asset prices.
Yeah, so when we say financial asset prices, what more can we dig into in and around that? Obviously, whenever I hear interest rates, first hot button thing that pops up in my mind is real estate, the real estate market.
Yeah, that's typically what people think is the borrowing side, right? And that, okay, if it's more expensive to borrow, less people will borrow, therefore, potentially less economic activity. But as far as how it relates to the financial markets, it really comes down to time value of money.
Okay.
That's kind of the foundation of finance. And as interest rates move up, you typically use some type of interest rate index or benchmark as a discount rate. And so higher interest rates means future cash flows are not worth as much to you in today's dollars. So if you have a projection that a company, will earn X amount or will have X amount of cash flow each year for the next 5 years, you then take those cash flows, you discount them back to present value, and that gives you an idea of the price, right, that you'd be willing to pay for those cash flows. If interest rates move up, then that price that you're willing to pay for those cash flows, even if those cash flows haven't changed, goes down.
Mm.
And if interest rates go down, the price you're willing to pay goes up. So it does have a big impact in terms of those discounted cash flows or present value type calculations.
Well, to me, that then prompts obviously this is has a great impact on the financial markets, bank lending, and so on.
Yeah, exactly. And, I mean, that's the interesting part. I mean, I think holding steady is the responsible thing for the Fed to do currently. And I know some are disappointed because they're calling for lower interest rates. They think, that will affect those areas of lending, right? That suddenly there'll be increased lending activity, which will lead to increased economic activity, whether it's real estate, like you mentioned, or, companies borrowing, right? Maybe now they look at this new project or build out plan, and if interest rates are lower, now it pencils. Now it pencils out, and they'll go. They'll do it. It'll create more earnings, more growth, more employment. If interest rates are higher or remain, kind of where they're at, maybe it doesn't pencil out, and so we miss out on that potential growth. But I'm not sure that's entirely true. The Fed only controls the overnight lending rate. So that's
Mm.
basically the shortest of the short-term interest rates, which is the rate at which banks lend to each other for a term of one night. The longer term interest rates are more determined by the markets and what people are willing to lend and what people are willing to borrow at. So, mortgage rates or, corporate rates on longer term projects, that's more going to be supply and demand. And I think one of the challenges that really is beyond the Fed's control is there's really high demand for borrowing when it comes from the federal government.
Hmm.
When the federal government's running such a large deficit, it's increasing the demand for borrowed funds. And, as long as the supply of those funds, the supply of money at which the market is willing to lend at, low, safer interest rates stays the same, it's going to push those interest rates up, right? It's going to increase the price. Increased demand is going to increase the price. And in this case, interest rates are the price of money. So I don't know that the Fed really has a big impact on that. I think, probably don't see any real shifts in terms of federal government, deficit spending. So that's likely to continue. So the only thing that would likely solve it would be an increase in the supply of money that's available to be lent out, which probably would only happen in a recession, right? Or a period where investors become very risk averse, and, they run for safety. And so therefore the, supply of money that's entering those kind of lower risk, bond markets increases and therefore drives down the price of money, or in this case, drives down interest rates.
Yeah. So what do we potentially risk here? I know you mentioned stagflation, so please elaborate on that. But what are some potential outcomes here moving forward?
Yeah, that's the big risk. And again, the Fed doesn't have any great tools to tackle that, right?
Mhm.
So, the risk would be if we enter stagflation, you could see interest rates rise because inflation's going up. And so people want to be compensated for that loss of purchasing power over time. So they want interest rates that exceed the rate of inflation. So higher inflation could actually push up longer term interest rates, even while growth is slowing, right? So that would be a scenario where we could potentially go into a recession, but instead of seeing interest rates fall because, people are running to safe assets, they're doing other things with the money to try and offset the inflation risk, rather than accepting low interest rates where they're losing purchasing power to inflation.
Yeah, yeah. So probably, I mean, for me, I think of it in this times, and again, just my perception, okay, this might be a time not to so much invest, reinvest, but maybe to hold on, especially if interest rates go up, get a little more value that way. And so I'm not spending as much. I'm doing a shift in my budget of what is that liquid cash and what's it going to go to, especially things beyond the necessary goods and services.
Yeah, it is time to maybe be a bit cautious and wait to see how this plays out because of the challenging environment that it represents.
Yeah. Anything else you want to add before we jump to corporate earnings?
Well, just that, we're kind of laying out the different scenarios here. It doesn't mean that it's likely or that those scenarios are going to happen, right? But it just means there's a increased probability or increased risk that they could occur. So it does lead to a slightly higher risk environment. If we start to see any of that start to manifest itself in the data in terms of, the inflation numbers going up, economic growth rates coming down, et cetera, then we'd have to assign an even higher probability and then probably really look at being more cautious. But if those factors don't make their way through to the data, maybe because there's some other strong underlying currents, which I think we're going to talk about here in a minute, then we'd probably assign the stagflation scenario a much lower probability. And I think that's the type of calculations that's going on at the Fed right now as well.
Yeah. Thank you, sir. Corporate earnings growth accelerated in 2025. Of course, with a lot of the geopolitical uncertainty currently impacting the market, it is a surprise that the majority of market indexes are not down more than they are. I mean, we talked about the recent volatility as the fourth quarter of 2025 earnings season closed. But I mean, there were some very positive signs.
Yeah, we're coming into this period of increased risk, really centering around the war in Iran and the disruption to oil supplies, in a really good place, right? And so I guess that's the positive is things could be a lot worse if we didn't have such a strong foundation coming into this. And a big part of that was the acceleration of earnings growth that we saw in 2025. I mean, 2025 it started out a bit bumpy, right? You had the companies bracing for the potential impact of tariffs. In the first quarter, S&P 500 earnings dropped by 6.59%, so a little bit of a dip. We saw that reflected in stock prices. But then earnings rebounded 9.4% in the second quarter, 7.7% in the third quarter, and not quite complete yet, but an estimated 10.4% in the fourth quarter. So you can see how that's pretty strong quarterly growth. If you look at that from an annualized basis, the year-over-year earnings growth exceeded 20% in the third quarter at 22.18%. And in the fourth quarter, it's expected to, post pretty similar results of 21.51%. So really strong earnings growth, which, historically over the long run is the bigger determinant of stock prices, right? Because as a stock investor or as an owner of a company, that's really why you'd want to own a company, is to participate in those earnings. And if the earnings are going up, obviously it's going to make that investment look more attractive.
Yeah, as far as the S&P 500, how does the earnings growth look now, and what factors are really playing into either the growth, the stagnation, whatever's happening?
Yeah, well, a lot of the growth that we saw, especially in the second half of last year, was driven by big investments in AI, right? And we've
Right.
talked about that on past episodes. And that seems to be continuing. It's maybe not quite getting as much press because there's other things going on that are, grabbing that headline or the front page. But for those of us that pay attention to those markets, it's still happening. The money's still flowing. And so the market may prove to be more resilient than normal, just because you have this very positive trend that is at least somewhat offsetting the potential negative impacts of some of the other events that are going on.
And just speculation here. Do you think that AI is just becoming more ubiquitous, not just for industries, but the household user and people, they're finally figuring out maybe a level of monetization around it, or?
Not necessarily for the household user in terms of what we're seeing. I mean, that's the vision, right? That it'll be something that all of us can use and that they'll be able to find a way to monetize it. There's been some talk about, kind of the ad-based model, which, internet search is built around, and kind of some back and forth there. But really where we've seen it is in business adoption.
Mm.
And a lot of the AI companies really focusing on that business to business market of, trying to automate certain business tasks, increase productivity, things like that. So that seems to be the focus at the moment. But we'll see, right? We'll have to see how it evolves. It's, yeah, there's just a lot of possibility and a lot of unknowns, and obviously a lot of hype and high expectations, which is why it's drawing in so much investment. What'll be interesting to see is, if this AI investment cycle continues, we had been earlier this year seeing more of a broadening of the market, right? Where some of these AI/tech companies were selling off a bit, while other areas of the market were, playing catch up, right? Which we've talked about is it's kind of a normal, healthy consolidation of the markets. With some of the risks around oil prices, oil supply, but we see a shift where we see the AI companies now maybe hold up because of that investment cycle still being quite strong and not being as impacted by the global energy markets. Whereas meanwhile, companies that are more reliant on energy as a major input, could suffer.
Yeah. Yeah. Anything else you want to add before we jump to stock indexes?
Well, I think you kind of have to just point out that we're talking about potential risks, right? But then we show these potential positive trends that we're seeing. So we're really in this interesting period of is it a divergence? Is it kind of which direction is the market going to be pulled when you have you can make both a positive and a negative case depending on what data you're choosing to focus on.
Yes, sir. All right. Stock indexes enter correction territory. The NASDAQ and Dow Jones Industrial Average both enter correction territory. What is correction territory?
Yeah, so in market lingo, a correction is a 10% or greater decline from the previous all-time high, right? So yeah, Nasdaq, Dow Jones have already hit that. The S&P 500 was close, although then had a couple strong days, so it's a little further away from crossing that threshold. But I think the lingo kind of portends something, which is they call it a correction because a 10% decline in stock values is quite common, right? Not
Mm.
really considered a big deal that you have a 10% pullback. There's lots of short time periods where the market kind of gets ahead of itself, gets some momentum, maybe brings some speculators into the market that really bid it up and then reaches a high and then goes through a period of consolidation or correction. That's in contrast to a bear market, which in Wall Street lingo occurs when the stock market declines 20% from its highs. And that's considered the point where it's a significant market decline and arguably that the market is starting to price in a recession,
Mm.
right? So we've seen a correction. We're still a long way from bear market territory. So despite the sell-off we've seen here, it's still not at that level where it's really signaling a major problem.
So, just for clarification here, so bear market, as you stated, 20% decline. Then is that when we say a bull market that this 20% increase, or is there a different threshold? I know that gets thrown around a lot. People, it's a bull market, it's a bear market. So, just to kind of give folks insight on when that is said and what it means.
That's a great question, and I don't think there's really an answer to that, right? I mean, a bull market is basically a positive market that just says it's trending upward, but there is not a real solid definition. So I guess it's whatever you want it to be. I think you could obviously make the case that if the market's hitting new all-time highs, it's a bull market, right?
Okay.
Otherwise, you'd probably call it a recovery until it gets to that new all-time high. But in terms of how much it has to go up or something like that, yeah, not really a set definition on Wall Street that would, define the term.
All right, thank you for the clarification. In summary here, essentially, it's kind of a little too early to step towards defensive action to protect a portfolio at this point. It's something to continue to watch because it isn't a guarantee that it'll totally dip to that point of market sell-off and so on.
Absolutely, yeah, exactly. It's a little too early to take defensive action, but it is time to be paying attention if the market continues to grind lower or, you have some news headline risk or something like that causes a big drop, then we may get there to the point where it's, time to, fall back on those defined risk management plans and, try to cushion the downside to an extent. But we're just not there yet.
Okay. Anything else you want to add to stock indexes enter correction territory before we jump to the bulletin board?
Well, just, I mean, as we always do, we'll continue to keep an eye on these things and act accordingly, right? Based on, the preponderance of evidence and, not going to, react just based on headlines or speculation or things like that, but, on defined strategy, that's been back tested and, has performed well in the past, that we believe gives you kind of a more logical approach to how you allocate risks through these uncertain times.
All right. Well, let's jump on over to the Plan Solutions Incorporated office bulletin board. We've got one item pinned up there this week. What is it?
Yeah, so we're getting towards the tax filing deadline of April 15th. So it's our annual reminder that personal income tax returns are due by April 15th. Now, I know a lot of people say, oh, well, just put me on extension, right? I mean, you can get an automatic extension of 6 months to file, which, pushes that extended deadline out to October 15th. But what is often lost, or what a lot of times people don't realize, is an extension. The extension is an extension of time to file your tax returns. It's not an extension of time to pay any taxes that may be due, right? So, you can't just say, I'll just deal with it later, put it on extension. You really want to prepare as much of the return as you can and then estimate the items that are missing. That way you can decide, okay, if you go on extension, does it make sense to make a payment with that request for extension to make sure that, when you do finalize the return later in the year, that you're not coming up short. Because if you do come up short, if you file your taxes after April 15th with the balance due, the IRS and state authorities, they may assess interest on the amounts due as well as underpayment, or late payment penalties. Sometimes it can even make sense to, make a payment, paying a little more, just to make sure that you're covered. But if you haven't even looked at it, it's really a shot in the dark, and you're potentially opening yourself up to that risk that in addition to possibly owing some tax, there could be some increased costs that go along with the filing.
Yes, absolutely. All right. Thank you, good sir. Anything you want to add while we wrap up this edition of the Plan Solutions Incorporated podcast?
Well, just on that last point, I mean, we're here to, help people estimate their taxes. We are coming down to the deadline, and if too many people wait till the last minute, it may be very difficult to be able to do all those calculations. So if people are not already on extension or haven't already completed their tax return, it's really time right now to start getting in that information and allow us to do those calculations. We just don't want to be in a situation where we're being inundated right at the deadline and just literally run out of having enough time to be able to get that work done.
Yes, absolutely. And if you need the contact information for Plan Solutions, it is in the podcast description, the phone number, website, and so on. And hey, thank you for listening. Please hit that subscribe button if it's your first time, and share with somebody else that you think will get value out of the podcast. We don't do any external advertising, so your word of mouth continues to help the podcast grow, and we appreciate it. And if you're like me and enjoy a nice visual when I listen to podcasts, you can go to our YouTube channel, youtube.com/@plansolutions, and you can follow along to a visual form of the podcast that has the personal financial review, the written content that Chase and myself discuss on screen. And if you have yet to subscribe to the personal financial review, it's easy. Send Katie an email, katie@plansolutions.com, and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.